Hi everyone, welcome. It's a pleasure to be with you all again. As usual, we are covering live the ECB's monetary economic policy decision here with Yohay and Mauricio as usual. Hi guys, how are you?
Hi Valeria, great to be
Hi,
here.
hi Valeria. Good to be here too.
Okay, great to be here. Well, in a couple of minutes from now, already the ECB is going to release its rate decision, and of course, we are all waiting for no change in there. The fact is that the ECB extended its quantitative easing program last December, so no action is expected today. But I do believe that focus will be, as usual, in Draghi's wording, right, Yohai?
Yeah, it's always the Draghi show, and he's not going to announce anything, as he said, but will he react to inflation? Inflation has been significantly stronger recently, thanks to rising oil prices. Even core inflation went up, especially in Germany. Or will he say that's only a one-off? We have to wait and see. Dovish Draghi, do you have any bias? Any
I do believe that he's always a bit more optimistic that what the economy offers usually. So that uptick in inflation above 1% for the first time in almost 3 years, or a bit more than 3 years, I believe he will grab that as a safe boat. You know what I mean? And offer us a hawkish stance today. But of course, it's my take.
Yeah, well, in the past also he did pat himself on the back. He said, thanks to the ECB, inflation is rising. We avoided deflation. We have growth. But question is, well, I guess he'll be asked about if they intend to change policy. And my guess is that he'll say we'll have to wait and see for a long time. We just made a big change in December.
Yeah, that's the second big thing that's going to happen today, because the market has been discussing the possibility of tapering. Even despite over the last meeting, they didn't discuss it. As Draghi said, it was not even bring to the table, right? He said that, and we know that in the minutes read last week. So I don't know. The market is eagerly hoping that he said something about tapering to keep on pushing the dollar lower. That's my personal view, of course, but that's what I'm waiting for today.
Yeah, I agree. I also think he would like to push the euro lower. We had the euro falling. It was great for lifting inflation, for exports. Now the dollar had some wobbles, got stuck a bit. So you would like at least the euro maybe to follow the pound. The pound did suffer some weakness, not when May spoke 2 days ago, but in general, the pound remains weak. The euro is a bit higher. So
Yeah,
I'd like to see a
they left everything unchanged. Sorry to interrupt you.
yeah.
We have practically no market reaction. The euro is stacked around 650, 660 as it was before that. And of course, as we were saying, it's the Draghi's show, right? Sorry to interrupt you. Just
No,
want to
no,
add.
yeah.
Nothing in the market actually reacted. Sorry.
Yeah, I'll mention the ECB has 8 meetings every year, just like the Fed. And also, just like the Fed, there are 4 more important ones when they release new forecasts. These
Yeah.
come like the Fed, December, March, June, and September. So now we're in the middle, the January decision.
In the middle of nowhere. I do believe that Bank
Yeah.
of England also added to that policy of just one meeting every 6 months, or every 6 weeks, sorry, or so. I do believe that Bank of England is thinking about doing the same. I read it somewhere, but I'm not sure about it.
Yeah, they have their Super Thursdays when they also release the quarterly inflation report, which
Yeah.
includes much more information, and they usually make the bigger decisions at that time.
Yeah. Anyway, and there's one little tiny thing that we should care about today, and it's the fact that tomorrow our friend Donald Trump will take the office, right? So if we don't get too much from Draghi today, the market will probably remain in wait and see mode and disappoint us all, waiting for some action, because it will quickly turn its attention towards tomorrow's events. That's a possibility also that we should consider today, right?
Yeah, that's a very big event. We had two main political shocks in 2016, Brexit and Trump. We had some follow-up for Brexit this week with the expectations to May's speech and then the reaction, and volatility was huge. So I'm hoping also with Trump's inauguration we have lots of action.
I do believe that what you just said about political woes, it will be the theme of the year 2017, you know. And what we get so far has been just a sample. But hey, the year's just starting. We are only by mid-January.
Right. Do you have
Anyway.
any specific expectations from market reaction around the inauguration tomorrow afternoon?
To be honest, I'm not sure. All what I can get from the news in here in my country is about all the protesters that are coming to New York for the Assumption. So I foresee some turmoil around the event, and that may affect the greenback. I do believe that the greenback is in trouble, and Trump is not going to help it.
Yeah, last week Trump had his first press conference after, I think, 6 months. First one after the election victory, that's for sure. And he did not mention fiscal stimulus, not infrastructure, not tax cuts. He did go into bashing some companies for moving their production to Mexico. So we got the negative things that Trump talked about in the campaign, the trade wars, and we did not get the positive things, the fiscal stimulus. It hurt the dollar, but Trump can always say something new every day, so it's really lots of uncertainty.
Yeah. Mauricio is saying that there's a question about oil, but I'm not sure. I can't see the question. Maybe he can share it with us. Anyway, what do you think about the euro dollar, I mean?
I think we were talking last time we had our coverage, or 2016, talked about the window for an opening for parity, euro dollar parity in January, if there's lots of hope from Trump. And I'm not sure we already missed it, but sort of on the first full trading day of the year, we went a bit lower, and now we're back a safe distance from parity. I don't think we'll get there. I mean, Trump needs to talk once again about fiscal stimulus to get there, and I think, or Draghi needs to be so dovish.
Yeah.
I think that parity is a bit hard to achieve at the moment.
Yeah, I believe the same. I believe that parity is now a case if we have super trouble in Europe and not much more reasons now. And indeed, I believe that what we are seeing is an upward corrective movement. I'm not yet seeing a bullish euro, but at least I'm seeing a weaker dollar, right? Moving far away from its multi-years highs we get like December, early January. What I'm particularly following in euro dollar is the fact that pair is struggling with the 710 level, which is the 38.2% retracement of the December-January decline. So my take is that if somehow we may settle above that level, the pair may recover up to 800, 840, which has been a major base during 2015 and 2016. And well, we have also the 50% retracement of the same decline there. So that's a probable level, a probable target we will get during the upcoming days, weeks. And it will take a clear break above it to talk about bullish euro, something I'm not seeing just yet.
Yeah, the dollar has been the driver for euro dollar so far this year, but it's important to remember we also have events in Europe and things could go bad also in Europe. Elections in the Netherlands in March. Most important elections are in France in April, May, and in Germany in September. So, and lots of other things can go wrong.
Yeah. Someone's asking, what about oil? Well, we will have the weekly US stockpile release in a couple of hours. So I would rather wait for the data before daring to trade nothing in here. But Gold has been holding about 52, and all of a sudden we are seeing it breaking lower. The fact is that we're expecting an uptick in production, an important rise in production in the US, right, for this year, according to the Energy Information Administration. They're waiting for a jump in production. And there are a lot of talks also about Iraq and Russia making new deals or increasing their production after June, it's June, because the OPEC deal that led to the output cut, it's going to last until then. So the market is reading this as a temporal solution, right, to the problem, and not the definitive one. And it's the bullish momentum we had when the deal was set. It's fading. I don't know if we have a good reading today, meaning U.S. stocks plummeting. The commodity will probably recover some ground, and we may see it back to 54.20, 53. But I'm seeing it in slowly entering a bearish trend, And if, of course, today's data is disappointing, there's a good chance that the commodity will plummet back to 50.
Yeah, we had this 52 level, which was double top, strong resistance for quite some time. When we finally made the break, it reached 55.20, which is sort of the top line, the high of 18 months or more. Then 54.50, the first high. But now I see the 52 level is a bit shattered, is a bit sort of, we went through this level so many times in recent days. So yeah, I'm looking to the downside at 49.50 because that was a low once we did, back in December. I see oil currently is sideways, looking for a new direction. At the beginning of February, we'll get some data about the OPEC deal, OPEC and non-OPEC deal, if they really implemented it in January. But as you said, if it's a deal for 6 months. So if they're already planning to increase production after these 6 months, that means it's not a long-lasting deal. Maybe it does achieve the goal of stabilizing oil prices in the short to medium term, but not afterwards.
Yeah, and yes, outside of the deal, and it's clearly rising output. I read a report from the AI yesterday that said that they're expecting production to grow around 40,000 barrels a day from starting February, putting a halt of a 4-month decline in production. So prospects are not good for oversupply market. Anyway, Draghi will be speaking about 35 minutes. At the same time, we will have some housing data coming from the US and the usual weekly unemployment claims also coming from the US. We may have an uptake in initial claims, but honestly, the weekly claims are at levels last seen in 1970 or something like that, meaning employment sector in the US, it's doing good. A rating, an uptake there could disturb the market a bit, but not much. The fact is that the main issue in the US keeps being inflation, right? And as long as we have inflation growing, as we do lately, then chances of a Fed hike will remain on the table. And therefore, the dollar won't be in free fall, okay? But of course, it's under pressure. There's an interim top has been set, and here we are waiting for a new direction.
Yep.
What do you think about pound?
Pound was very exciting this week, that's for sure.
Yeah.
Big day was Tuesday, of course. This is the daily chart I'm showing now. You can see big leap. So I think markets overreacted to worries about what May said, and then we had this weekend gap under 120, and then it was a huge short covering. Also, markets thought, clinged on to things that were, not so news, not such big deals, I think. So we're promising to pass the final Brexit deal through Parliament. Well, that's down the road at some point, and to have a phased out deal. That's not such a big surprise in my opinion. Anyway, I believe the pound will remain under pressure for some time. Brexit means Brexit, said Theresa May. I say Brexit is still Brexit, still less trade, still uncertainty. And I don't see many more days of such jumps of 3%. So
Yeah, rather towards downside than towards the upside, right?
yeah. Well, I want to see that, but have to be a bit realistic, I think.
Yeah, no, I don't know. As you said, Brexit is Brexit, and in the long run, it will harm the pound. Okay, so I can't see how the market can do anything but sell those spikes we get, and it's actually what happened because 24 has now become sort of a line in the sand. We have a couple of highs in there uh, this month, and I don't know. I can see the pair even going up to 25, and then back. Uh, I can see how the Brexit could be good for the UK economy. Not yet. Maybe I'm wrong, but at the long run, economy will start to shrink, and macroeconomic indicators will begin to reflect those lost deals.
Yeah. This week we have the World Economic Forum in Davos and lots of bankers speaking there. And they're beginning to talk about, well, once again, about moving offices, moving people out of London. So it's not good news for the UK economy.
Yeah, no good then. Okay, sorry. Okay, the year is it's an advancing some, but for what I can see, it's the dollar that's weakening against all of its major rivals. We have no macroeconomic releases in between the rates and now, so it's the wait and see for us.
Yeah, we're still very much in the same tight range.
Yeah, with the greenback slightly lower. Dollar Japanese yen was a big surprise for me. It jumped almost 200 pips with our friend Elam reached almost 15. Now it's holding there flat, but it was a big surprise actual move because I was expecting further slides in there and a lot of weakness. I don't know. Let's see how today data came in. If US data disappoints, the pair would probably fell quickly back below the 14 level.
Yeah, she didn't. Yesterday we had a speech from Yellen. If you actually take your time to read it in full, she didn't say too many new things, but the market did take the opportunity to ride higher, and that, well, she said that U.S. economy is getting closer to full employment and that inflation is gradually getting back on track. But of course, they have to move very cautiously. Again, markets wanted to hear only the upbeat stuff, only the positive things, and I think, yeah, it was an opportunity to take profits on dollar shorts, I guess.
Yeah, I see it more like a profit taking rather than anything else. But well, we see the market has reignited your positions at better levels. So well, there we are.
Yeah.
The also became stronger. It's another one that's doing good, but I do believe that the Aussie has a bit more of macroeconomic support to do this because of rates differential and the improvement in the situation in China, right? And of course, China imports base metals and Australia sells them. So relief coming from China with better economic readings, imports jumping, and all the improving indicators are backing this rally in the Australian dollar. Employment data was a bit tricky, the one released yesterday, because the headlines were more or less encouraging, right? The economy created more employments than the market was actually expecting. But I was reading the news in detail, and the unemployment rate has rise to 10 point something percent. I don't remember exactly, but it's its highest reading in over a year. Australia is having a lot of issues with underemployment, part-time employment. So headlines, despite looking encouraging, are not actually that much, because what we see is a total of jobs created, and some of them are not real stable jobs. But anyway, the market is reacting to the headlines still. At some point, if the situation continues, that underemployment or partial employment will actually affect the main headline, and the pair could reverse sharply once the market realizes things are not doing so good and there's rising chances of a rate cut coming from the RBA.
Yeah, as you said, the employment report was mixed. At least the Chinese indicators look okay. But yeah, Australia is not moving positively so fast. We have seen the Aussie recover, but hasn't gone very far.
It has when compared to other pairs, but
Yeah,
yeah, you're right. We are 300 pips, less than 300 pips away from 2016 high. Of course, I believe that the Reserve Bank of Australia will become a bit nervous if the pair moves above 77. I believe that they love it when it's around 72, right? But,
yeah.
well, let's see. 72 is my take on the central bank comfort zone, right? So if we
Yeah.
approach to 80, they will not feel that comfortable.
Yeah, they'll begin complaining.
Yeah, as usual.
Tomorrow is Trump's inauguration. We talked about that. The ceremony begins at 5 GMT. That's around when Europe closes. That means if we'll have any executive orders that Trump signs, it'll be just around when markets close, when liquidity is quite thin. So it could be messy. I think we'll have the full reaction to any news, the first decisions of Trump, the White House. We'll see it only on Monday when Asia opens.
Yeah, most stronger reaction will come then. Sorry, I thought I had my phone without volume. Okay, sorry.
Yeah.
We have a question about gold. Do you want to take it?
Gold, it's more your field, no?
Okay.
Okay. Well, yeah, sure.
Okay, no problem. Well, I forgot to place my financial retracement in here, but it's doing pretty much the same that the euro dollar. It has corrected around the 38.2% retracement of December, the November rally. Sorry, the post US election fall. It's around 12.04 and the 38.2%. So actually, we're struggling in here with a major resistance support, depending on where you are standing. But anyway, the latest recovery seems pretty much corrective. We have discussed plenty of times that 1100 is too close to production costs to be a level easily broken. So for now, what I'm seeing is an upward corrective movement, and now the commodity is struggling at a major resistance level, right? To be honest, I don't believe the gold can rally much more than what we've seen. Yeah, it can in intraday spikes, but in the long term, it will begin to ease from these levels, because at the end of the day, it's a safe haven asset. It doesn't offer nothing, no kind of yield to investors, and even a weak dollar can offer more. Holding a weaker dollar can offer more than holding a gold. So beware of that. Beware of speculative interest taking it lower. At this point, I'm seeing some bearish divergences in technical readings in the 4-hour charts. I could say that if somehow the euro strengthens, the commodity can go to 12.11, 12.15. That's my first target. Above that, the highs near 20, and not much more, to be honest, for today. On the other hand, if we are seeing some buying interest around 11.98, so I could expect that a bearish acceleration below that level would drive us back lower, back to 82 or so.
Yeah, the bigger levels, looking here at the chart, gold is, well, our 1120, below we reached late December, but went hand in hand with the dollar strengthening, and yeah, 1240 or even higher, 1340. So, but I also tend to agree that there's no big potential for gold. No, it cannot fall too far, as you said, because there is some demand for gold in industry, but in terms of, but also can't go too far. Not enough safe haven demand.
No, yeah. Of course, it's in the long run, and with all the political turmoil coming, who knows, right? But we are talking in the shorter term perspective. Who knows what will happen with elections in Europe, but with Trump first 100 days. I'm eagerly waiting for these 3 months to run and see how much of what he said he will do.
Yeah, he said he'll do many things on day one, and that's tomorrow. So, but then of course we refer to,
yeah, in the first hour he will got rid of Obamacare, right? That was he said, something like that.
yeah,
In the very first hour, that was his wording.
yeah, made many bombastic remarks, but if I understand correctly, Obamacare is quite complicated, and they cannot just repeal it without any kind of changes, replacements, things like that. So
Yeah, well, I didn't say I will take care of, of Obamacare. He did.
yeah,
He's president.
yeah. Yeah, but the
Uh,
focus of Republicans on Obamacare means that they're not focusing on fiscal stimulus, and that the markets don't like that, of course.
yeah, I don't know. I do believe that we are going to have more fun with Trump this year that we had last one with Draghi and the confetti girl. You know, it's a source of joy for to the our friend Donald Trump, which is good because if the market is flat and lifeless. Okay, we can get our pips, but with all the ongoing things, we will get volatility for the most.
Yeah. We'll either get good news for the world and low volatility, or bad news for the world and lots of action in markets.
Yeah. I remember, like, I don't know, 8 years ago when we had the crisis in the US, 2007, 2008, people talking about the possibility of dollar losing its condition of the leading currency, the leading asset.
Oh, yeah, I remember that.
Yeah, do you remember?
Yeah.
I remember back then I said that could happen, but not in my lifetime, right? I was right. I still think the same, right? No matter what happens or how much turmoil we got in the US, in Europe, or whatever, the gold will continue. We will continue trading gold against the greenback, crude against the greenback. Not just trading, but the main quotations of these commodities will be read in dollars all across the world, right? If you want to buy gold, you will get it on in dollar quotation and so on. So
Oil.
sometimes, oil or gold in dollar quotation. So I can see the case for much of the market's forecast in the long run being valid. But I can send that, and indeed we are going to get some action this year, much more than what we have seen over the last two.
Yeah, it's not going to be no drama Obama. It's going to be Trump train.
Media circus we are going to. But that won't kill the greenback, guys. Never. Not this time.
No.
If the 2008 crisis didn't do it, nothing will.
Yeah. Yeah. Trump said he's going to make America great again, so it's going to be the Donald dollar. Well, the dollar might still fall in value, but its status as a reserve currency will remain for foreseeable future.
How many billions dollars are stuck in worldwide central banks? China, Russia, even, I don't know. The euro, on the other hand, has not such a clear fate. Brexit has been tough, right? And despite we are not discussing the matter, Greece is not doing nothing near good, guys. I do believe that Greece it's suffering even more than it did last year. We have forgotten headlines about Brexit, right? But it's there. The Brexit is there. And that will destroy the euro areas and union. Of course, it won't destroy Europe, and it will hardly affect Germany. But I see more odds of the euro area dissolving than the dollar being really harmed by Donald Trump.
Yeah, agreed. Both are extreme scenarios, but of course, a breakup of the Eurozone or significant changes in the Eurozone are far more likely. The French candidate Marine Le Pen of the Front National, extreme right, she wants a Frexit. She wants change.
Mm-hmm. Yes, sorry, go on. I said, yeah.
Yeah, of course, according to polls, she's not expected to win. The second round will probably see her against François Fillon of the center-right, and then left-wing voters will come out and vote for him, and he'll be the president. That's the baseline scenario, but we had so many surprises.
Yeah, Trump wasn't supposed to win either.
Not the Republican primary.
Yeah, neither that. Okay, they were asking about the $1.20. As I said earlier, I'm a bit surprised with the strong recovery we got in here, up to almost 15. So I do believe that the upcoming event, the ECB, won't affect the pair that much. The market will save its bullets for tomorrow, for market's reaction to Trump getting into the office. So beware of that. But I don't still see it recovering ground farther at this point. If it lost for 114, yes, 114, I believe that the pair will probably resume its bearish trend. I'm more inclined to saying the dollar definition at this point than buying it. Not sure. Honestly, the recovery, I need more information before taking a decision with this one right now.
Yeah, dollar yen oftentimes best reflects the movements in the dollar in general. In this case, Trump inauguration, if he talks more about fiscal stimulus, it's good for the dollar, good for dollar yen to rise. If he talks more about trade wars, renegotiating NAFTA, retaliating against China, things like that, it's more risk off, and that's good for the yen, bad for dollar yen.
Yeah. Okay, 12 minutes to go.
Yeah, for the Draghi show. Last time it was a good one.
It was. The minutes were a surprise also.
Yeah.
So let's see what we're going to get today. Market waiting with the dollar weak.
Yeah, dollar is on the back foot. Euro dollar is a bit higher on the day, about 40 pips higher, but basically waiting for Draghi. Today's range is around 55 pips. But,
In euro dollar. Yeah.
Yeah, in euro dollar, yeah. Let's see what he does. At the same time, we also have a few US releases for those joining us now. Weekly jobless claims, no big changes expected, 254. Housing starts and building permits, and these housing figures sometimes offset each other. One is a positive surprise, one is a negative one. And also the Philly Fed Manufacturing Index. So nothing which is top tier, and many opportunities for the data to go mixed. So the focus is on the euro.
Yeah.
And my
Housing sector is, I do believe that we are going to get more action from housing ratings and the unemployment ratings. But well, let's see. There's a question for you. Yohay says, what can we expect from Draghi today? Any opportunity for anything like a firework?
I wish, but no, the fireworks, we've seen them last time. Last time was a more important meeting. It included new forecasts and included the announcement about extending QE until the end of 2017, reducing the amount from April from 80 to 60 billion euros a month, and also a change in yields. Now they can buy bonds with yields under minus 0.40. And they also changed the inflation forecast, or made it basically depressed, nothing really optimistic. So this time, nothing is expected. But I would say that if Draghi is happy about rising inflation data we've seen in the past few weeks, then euro will probably rise. If it's a wait-and-see approach until March, the next forecast, then nothing significant. And if he's totally depressed, subdued, dismissing inflation, the euro will go down. But again, this is sort of sorry.
He won't be that depressed. He hardly is.
Yeah. Anyway, that's Draghi making a I don't know face. Or what do I care? Or a bit depressed. Anyway. And since they made such big announcements last time, any changes to QE, any announcements about changes to QE, I think will come not before June, the earliest. So
I agree with you on that. They wait until the last minute.
Yeah. So the program was expected to end in March, was planned to end in March, and in December, 3 months beforehand, they announced the changes, the extension until the end of the year.
Yeah, so I expect the same behavior this time, waiting until the last possible minute.
Yeah, they'll have lots of new data until then.
Someone's asking which pairs will you guys be trading? Well, it depends on the market's reaction, but we are hoping that the euro dollar will be the one that reacts most, followed by all euro crosses, at least me.
Yeah, euro dollar is what I'm focusing on. And
Okay, someone's asking, Draghi mentions tapering good it weaken or strengthen the euro. Strengthen the euro. The mere possibility of tapering will probably push the euro through that 710 region we have seen earlier this week. The last time they had a policy meeting, however, Draghi denied they discussed the tapering, and even though the market did not believe him and still believes there will be some sort of tapering announcement over the upcoming months. I'm not agreeing with that. I'm just saying what the market is thinking and waiting and hoping for. Okay? Particularly after the minutes we got last week showed that many members of the commission were against extending quantitative easing. Most of them believe that it's a tool that should be used as a last resource. But I do believe that Draghi doesn't buy that idea, right, Yohay?
yeah, because inflation is still depressed. Core inflation, even though it finally moved from 0.8, it went only to 0.9. This could be only a one-off, and I think most of them, including Draghi, they think that the European economies still need the support of the European Central Bank, the extremely loose monetary policy, because the growth that we're seeing in Europe is still not self-sustained. It doesn't stand on its own. So
The swallow doesn't make a summer.
yeah,
That's what happening with inflation in your area, right?
we'll have to see real growth, real optimism, investments that are lacking, and then the ECB might retreat. And yeah, they will not wait to see the white in the eyes of inflation. They might begin removing extreme stimulus beforehand, but they want to see something a bit more substantial.
I believe that Draghi mentioned something about slowly reducing stimulus down to zero, meaning he's not going to trim it in one stand. He's going to slowly reduce it. But well, if you reduce it, but extend it for 9 more months, or that won't be helping much because it will take a couple of years to reduce 20 billion every every 9 months. But well, maybe yeah, maybe that's what he's thinking. But well, who knows?
Yeah, or maybe if things really get better, then towards the end of the year they'll tell us, okay, from January 2018 we're beginning tapering down like the Fed did, reducing it by 10 billion euros a month every month, and stopping bond buys in the middle of 2018. But we'll really need to see a pickup in growth, acceleration in inflation, and then otherwise I see them extending it a bit more, 60 billion for another 6 months, another 9 months, and only then thinking about tapering it down to zero. So it's still a long path anyway. Today, in a few minutes, we'll hear from Draghi. I don't believe you'll see anything. I think they'll let the recent decisions run for some time. Yeah. 3 minutes to go.
Yeah. Are we going to have the transmission? I do believe so, right, Mauricio? Yeah, he's getting ready. 2 minutes of, and 17 seconds, says the frozen screen we are seeing.
Yeah.
2:04. Okay. Almost there, almost there. Come on, Mario.
Yeah.
Give us something to work with.
Yeah, euro dollar is very, very stable, 106.68. Just before Draghi begins talking, let's see if it moves. One minute to get some US data as well.
Yeah.
So
Less than 1 minute to go.
yeah. Okay, some US data coming out. So US jobless claims fell to 234,000. That's good news, better than expected. Housing starts 1.226, a bit better than expected. Building permits 1.210, a bit under expectations. So as usual, these figures offset each other.
Yeah.
And I'm waiting for the Philly Fed.
Dollar is higher, just modestly. Take a look at the Swissy. And
Yeah, I think Draghi is entering.
just
No,
modestly.
not yet. Yeah. Falling jobless claims is, of course, good news. I see a small upwards revision from last week's figure from 247 to 249. But this week's figure is 234. As you mentioned earlier, the lowest since the 70s, these kind of levels. The job market is doing well in the US. Here we are, the Draghi.
Okay. Pound is having a hard time to hold above 23. Okay, let's hear what's happening.
First of all, let me wish you a Happy New Year.
Happy New Year.
Vice President and I are very pleased to welcome you to our press conference. We'll now report on the outcome of today's meeting of the Governing Council. Based on our regular economic and monetary analysis, we decided to keep the key ECB interest rates unchanged. We continue to expect them to remain at present or lower levels for an extended period of time and well past the horizon of our net asset purchases. Regarding non-standard monetary policy measures, we confirm that we will continue to make purchases under the asset purchase program at a current monthly pace of 80 billion euros until the end of March 2017. And that from April 2017, our net asset purchases are intended to continue at a monthly pace of 60 billion euros until the end of December 2017 or beyond if necessary. And in any case, until the Governing Council sees a sustained adjustment in the path of inflation consistent with its inflation aim. The net purchases will be made alongside reinvestments of the principal payments from maturing securities purchased under the APP. The Governing Council today also decided on further details on how the Euro system with yields below the interest rate on the deposit facility under its public sector purchase program. These decisions will be published in a separate press release at 3:30 today. The monetary policy decisions taken in December 2016 have succeeded in preserving the very favorable financing conditions that are necessary to secure a sustained convergence of inflation rates towards levels below but close to 2% over the medium term. Borrowing conditions for firms and households continue to benefit from the pass-through of our measures. As expected, headline inflation has increased lately, largely owing to base effects in energy prices, but underlying inflation pressures remain subdued. The Governing Council will continue to look through changes in HICP inflation if judged to be transient and to have no implication for the medium-term outlook of price stability.
$1 is falling.
A very substantial degree of monetary accommodation is needed for euro area inflation pressures to be headline inflation term. If warranted to achieve its objective, the Governing Council will act by using all the instruments available within its mandate. In particular, if the outlook becomes less favorable, or if financial conditions become inconsistent with further progress towards a sustained adjustment in the path of inflation, we stand ready to increase our asset purchase program in terms of size and or duration. Let me now explain our assessment in greater detail, starting with the economic analysis. Euro area real GDP increased by 0.3% quarter on quarter in the third quarter of 2016, after recording a similar pace of growth in the second quarter. Incoming data, notably survey results, point to somewhat stronger growth in the last quarter of 2016. Looking ahead, we expect economic expansion to firm further. The pass-through of our monetary policy measures is supporting domestic demand and facilitating the ongoing deleveraging process. The very favorable financing conditions and improvements in corporate profitability continue to promote the recovery in investment. Moreover, sustained employment gains, which are also benefiting from past structural reforms, provide support for private consumption via increases in households' real disposable income. At the same time, there are signs of a somewhat stronger global recovery. However, economic growth in the euro area is expected to be dampened by a sluggish pace of implementation of structural reforms and remaining balance sheet adjustments in a number of sectors. The risks surrounding the euro area growth outlook remain tilted to the downside and relate predominantly to global factors. According to Eurostat, euro area annual HICP inflation increased markedly from 0.6% in November 2016 to 1.1% in December. This reflected mainly a strong increase in annual energy inflation, while there are no signs yet of a convincing upward trend in underlying inflation.
No convincing.
Ahead, on the basis of current oil futures prices, headline inflation is likely to pick up further in the near term, largely reflecting movements in the annual rate of change of energy prices. However, measures of underlying inflation are expected to rise more gradually over the medium term, supported by our monetary policy measures, the expected economic recovery, and the corresponding gradual absorption of slack. Turning to the monetary analysis, broad money M3 continues to expand at a robust pace, with its annual rate of growth increasing to 4.8% in November 2016, up from 4.4% in October. As in previous months, annual growth in M3 was mainly supported by its most liquid components, with a narrow monetary aggregate M1 expanding at an annual rate of 8.7% in November, up from 8% in October. Loan dynamics followed the path of gradual recovery observed since the beginning of 2014. The annual growth rate of loans to non-financial corporations was 2.2% in November 2016, after 2.1% in the previous month. The annual growth rate of loans to households was 1.9% in November, after 1.8% in October. Although developments in bank credit continue to reflect the lagged relationship with the business cycle, credit risk, and the ongoing adjustment of financial and non-financial sector balance sheets, the monetary policy measures put in place since June 2014 are significantly supporting borrowing conditions for firms and households, and thereby credit flows across the euro area. The euro area bank lending survey for the fourth quarter of 2016 indicates that credit standards for loans to enterprises are broadly stabilizing, while loan demand has continued to expand at a robust pace across all loan categories. To sum up, the cross-check of the outcome of the economic analysis with the signals coming from the monetary analysis confirmed the need for a continued, very substantial degree of monetary accommodation to secure a sustained return of inflation rates towards levels that are below but close to 2% without undue delay. Monetary policy is focused on maintaining price stability over the medium term, and its accommodative stance supports economic activity. In order to reap the full benefits of our monetary policy measures, other policy areas must contribute much more decisively, both at the national and at the European level. The implementation of structural reforms needs to be substantially stepped up to increase resilience, reduce structural unemployment, and boost investment, productivity, and potential output growth in the euro area. Structural reforms are necessary in all euro area countries. In particular, reforms are needed to improve the business environment, including the provision of an adequate public infrastructure. In addition, the enhancement of current investment initiatives, progress on the capital markets union, and reforms that will improve the resolution of non-performing loans are a priority. Fiscal policies should also support the economic recovery while remaining in compliance with the fiscal rules of the European Union. Full and consistent implementation of the Stability and Growth Pact over time and across countries remains crucial to ensure confidence in the fiscal framework. At the same time, it is essential that all countries intensify efforts towards achieving a more growth-friendly composition of fiscal policies. And we are now at your disposal for questions.
Draghi. There are no convincing signs of an upward trend in inflation.
Draghi, you indicated that the ECB stands ready to do more if the outlook deteriorates. Is the ECB also ready to do less if it continues to outperform? I think last time you indicated this was a high-class problem. I just wondered if you had any update on that. Second question is on the US President-elect Donald Trump. He's made some comments this week about the dollar that led to a fall in the dollar. And I wondered if you were worried about what this might mean in terms of a future currency war, or perhaps about some of the other suggestions you've made about an increase in protectionism, and how that might
answer the second question.
Thank you. Well, you asked me whether it's still a high-class problem. The answer is yes, it still is a high-class problem. We haven't discussed it anyway. The second point, really, it's very early for us to comment on the to-be President Trump statements. Just early. The only thing that I can recall as far as exchange rates are concerned is that something that you heard me say many times. The exchange rates for us are not a target, but they are important for price stability and growth. And there is a very strong international consensus in the G20 and the G7 to refrain from competitive devaluations. So there is a whole protocol in the various statements by the G20 and the G7 that basically states how countries should behave with respect to exchange rates. That basically states how countries should behave with respect.
Thank you very much, Andreas Franke from Reuters. Two questions for you, Mr. Draghi. One on the inflation again. Thank you very much, Andreas Franke from Reuters.
We lost it.
Two questions for you, Mr. Draghi. One on the inflation again.
Oh, here we are.
We lost it.
On the Brexit front, in her last speech, the British Prime Minister made clear that there will be a hard Brexit. What does it mean for the ECB and for your outlook on inflation and growth? This is clear. Thank you.
Thank you.
Brexit.
Yeah. All is subject.
The answer to the first question lies in what we define as our objective. We define our objective, first of all, in medium term, over a medium term horizon. That's the relevant policy horizon. Second, it has to be a durable convergence, so it cannot be transit. Third, it has to be self-sustained. In other words, it has to stay there even when the extraordinary monetary policy support that we are providing today will not be there. And fourth, has to be defined for the whole of the Eurozone. I think these are the four features that always characterized our objective. On the second question, simply say, again, it's too early to say. The final outcome of the negotiations will be very important, but it also whether it will have economic consequences will depend on the shape of the outcome and the length of time it will take, and so it's too early to comment. Thank you. Jones?
Claire Jones, Financial Times. Two questions, if I may. We are now seeing quite sharp divergences between headline inflation rates in weaker member states and stronger parts of the region, such as Germany. How do you handle the communications and the policy challenges that this presents? And I think there's also some concerns that members of the council think there could be difficulties in finding enough bonds to buy under QE, and that could, in effect, limit your ability to hit your inflation target through the programme as it now stands. If core inflation remains weak and you need to carry on buying in 2018 and even beyond that, how do you intend to do that, given that there are these constraints in the assets that can be purchased under the programme?
Thank you. Well, the answer to the second question is actually given by our decision in buying below the DFR rate at short-term maturity, the details of which will be released in the press statement I mentioned before. That has greatly enlarged the eligible universe, and we are confident about the smooth implementation of our program. So we see actually no problems on that front. The whole strategy will be, as I said, delineated in the press statement, but we stand ready to upgrade the strategy or to revise the strategy as needed. Also, these purchases below the DFR rate, don't forget, will happen if needed, if they're required. And now, on the other point, it's too early to say. Let me say one thing about the Governing Council of today. The discussion was unanimous in looking back at the monetary policy decisions taken in December and stating that they were the right policy answer to the contingencies as viewed, as estimated in December. More generally, there was a sense of satisfaction towards the monetary policy stance that we have been pursuing now since 2014. It's increasingly clear that this policy stance had been successful. We've seen that since 2015, we had each and every quarter GDP growth between 0.3 and 0.6% quarter. We've seen that in December 2016, consumers' confidence is the highest since April 2015. The Economic Sentiment Index is the highest since March 2011. The PMI Composite Output Index is the highest since May 2011. Unemployment in November last year was 9.8%, the lowest since July 2009. So, by and large, the euro area has created 4.5 million new jobs over the last 3 years. And, more directly related to the question you asked, we've seen that the dispersion of the value-added growth across countries is at an all-time low since 1997. So that gives us a sense that if there are heterogeneities, and there are indeed in the speed with which we are approaching our objective, they can be coped with. It gives us a sense that the recovery is resilient. At the same time, we see that inflation is mostly driven by energy prices, and we see the underlying inflation pressures remaining subdued, and especially nominal wages growth remains subdued. On top of that, we see, as I mentioned in the introductory statement, the risks coming from the global uncertainty situation.
Valeria with CNBC. I have two questions, if I may, as well. One is a little bit technical. So going forward from April onwards, you're reducing the asset purchase to 60 billion euro. Does that mean that you're cutting all these individual programs like the sovereign debt and corporate bonds or covered bonds pro rata, or are you planning on shutting down individual programs altogether? That would be the first, more technical question, as I was saying. Then, second one is, how do you address German critics? It's getting louder and louder, I would say, with even Wolfgang Schäuble, the Minister of Finance, of course, stepping out and urging for a normalization of your policy, which is, of course, quite vocal. So, what are you telling them?
Thank you. The first question is we haven't discussed that. To the second question, actually, if you're referring to the very last statement by Mr. Schäuble. He actually said that there are political problems in explaining the monetary policy stance of the ECB. So that is a very understandable statement. And so the point, what I would say is basically the same thing I've been saying now for a few months. It's low rates are necessary now to get higher rates in the future. The recovery of the whole of the Eurozone is in the interest of everybody, including Germany. The German savers have benefited, not only as savers, but also as borrowers, as entrepreneurs, as workers, like all the other citizens of the Eurozone. So we have to be patient. As recovery will firm up, real rates will go up. Having said that, since our last decisions in December, however, there is more room to diversify into the medium-long-term spectrum of the yield curve, gaining actually a better rate than the very short-term one. So that is, in a sense, if anything, the what you call the rate of return conditions have improved in the last month and a half. But really, an honest answer would be just be patient. As the recovery will firm up, real rates will go up as well. And this will happen for Germany and for other countries as well.
Okay. So Draghi continues his press conference. Well, what we heard so far is quite dovish. He said that inflation, the rise in inflation, is mostly due to energy prices, and that underlying inflation remains subdued. Wage growth is subdued. Basically, they also said that the decision in December that wasn't unanimous at the time was now was accepted as a good decision unanimously. All in all, dovish things, euro-dollar is lower.
Yeah.
Valeria?
Yeah, I believe that the dollar is got a boost also from positive US data, right? And a bit of a disappointment coming from Draghi, as he said, more dovish than expected. I'm surprised that what we were commenting earlier, about being just one positive figure and not enough to trust it. I would have expected him to be a bit more optimistic with that positive number, but well, he was honest. Let's say that.
Yeah, he did say that this policy is good for the Eurozone, that everybody's benefiting from it, that it has results, but yeah, each time talked about inflation, downside risks, and a lot more stimulus needed, and basically more dovish.
Yeah. So, quite a disappointment for those looking for an optimistic Draghi. The euro, however, held above 600. Seems the market is not really willing to get rid of its long position in the euro, maybe taking some profits out of the table as we discussed earlier, and probably buying at better levels, the euro, I mean. So I don't know. The pound has also saw a shallow downward corrective movement, but struggling around 23. Japanese yen pushed through the year daily high, but it's back, unable to settle above 15. I'm a bit of life for the greenback, but not enough. Market will probably wait for our friend Trump, unfortunately.
Yeah, again, I'll remind that this is not the ECB's most important decision. It had a big one in December. So this is sort of an anticlimax. We still got some nice movements in euro-dollar, but not huge ones.
Okay, pretty much that's it. We are going to get the opening in about 30 minutes. And let me check out where stocks are. Okay, European one slightly higher, American one slightly lower, but nothing really relevant going on in there.
Yeah.
Okay, I do believe it's time to say goodbye, guys. In about an hour, FXStreet will hold a panel about Trump's election. And guys, don't miss it because it's going to be big and we have a lot of good experts there who will discuss what will happen with the market and what could happen in the market. So I do believe that's it for today. What do you think, Yohay? Time to say goodbye?
Yeah, time to say goodbye. Fasten your seatbelts for 4 years of Trump and beginning tomorrow.
Yeah.
And,
okay.
When is our next live coverage?
What? Our coverage?
Next, the next one. Well, stay tuned on FXStreet and you'll know. Anyway, here's the panel for how to trade President Trump with Boris Schlossberg, Joseph Trevisani, and Harry Dent. Can't hear you.
Yeah, okay, guys. I think we lost Valeria, but everything was doing well. Thank you, Yohay, and thank you, Valeria.
Thank you, Mauricio. Thank you, Valeria. Great to be here with both of you, and see you next time.
Yeah, I think the next coverage will be the ECB on the 1st of February, I guess, and the 2nd of February we'll have the Fed, if I am not wrong. Okay.
Okay.
Okay, Yohay, thank you very much, and see you next time.
Okay, thank you. Bye-bye.
Bye-bye. And guys, don't miss the next panel. It will be an awesome panel, a fantastic panel, a huge panel with Donald Trump president, about the Donald Trump president, with Harry Dent, Joseph Trevisani, and Boris Schomburg, with the moderation of Ross Barland. Thank you very much. Peace and have a good day. See you in 1 hour. Bye-bye.